silver's going to rush those old highs. It's been a major technical and fundamental mistake for it not to have already done so, along with copper, for example, and gold. And on a monetary basis, in real dollar terms, if you undegrade the price of silver and put it in line with where the degraded dollar really is now versus where it was in 1980 or 2011 peak in silver probably be $200 an ounce just to match those highs in real spendable dollar terms. In other words, to compensate for the monetary degradation. But we're just talking technically about this particular surge because we think those two highs, we call them idiot highs. Frankly, because they are stupid, because they're so many decades ago that they're next to meaningless in real value terms. We know the supply-demand in silver for several years now at least has been tight. There's not excess production in relation to demand. And in fact, there's a whole new demand quadrant out there, the solar panels. And China's a big consumer of silver for the purpose of, they're like 80% of the world's solar panel production. That's one factor. But the other factor is this, just over time, monetary metals advance, not because of this war or that war. In fact, wars are usually a negative for them. It's due to underlying monetary degradation that is ongoing. So if you look at an M2 chart, money supply chart on the Federal Reserve site in St. Louis, you see this upward curving ballistic chart of the growth of money. And if you go in and pick beginning in 1960 and then get the number for 1970 and do the math, 70 to 80, 80 to 90, you'll see the annual growth is, like 80, 90%. Every decade, 80 to 90%, meaning good percent every year. We're increasing that now. In fact, that chart is starting to go parabolic a bit. But over time, gold will match the ongoing degradation in a fiat currency. And obviously, when you increase the supply, it degrades its buying power. So that's why a loaf of bread when I was a kid was 20 cents and now it's not. Okay. Degradation of money, or why, when your granddad built a house, it was $4,000, now it's $450,000, same house. Ongoing degradation in money.
Silver's long-term case isn't just about solar panels, it's about money itself. Decades of monetary expansion by central banks have eroded the dollar's purchasing power. The Federal Reserve's M2 money supply chart reveals exponential growth since the 1960s. Bread once cost cents, today it costs dollars. Houses that once sold for $4,000 are now hundreds of thousands. This isn't about wars or short-term crises. It's about structural currency debasement. Historically, gold has kept pace with this decline, while silver lags behind before surging violently upward, correcting decades of undervaluation in short, dramatic bursts.
And gold, if you plot over history, will keep up with that degradation in the fiat currencies. Silver is a traveling partner with gold. Yes, it underperforms, and then it suddenly, as you pointed out, like in 1998 to 2000, went ballistic on the upside. 1979 to 80 went ballistic on the upside, and then again from that about 2010 to 11, it went ballistic very quickly. In other words, what it took several years to do, it suddenly did in 4 or 5 months. But if you go back and assess where silver might be now, given the ongoing degradation decade by decade in the money supply, why should silver be lower than it was in 1980 or 2011? What doesn't make any sense? Gold is well above those levels. In fact, even copper is above its 2011 highs. Copper, okay. Why shouldn't silver be? I think it's just a grand mistake. Markets make mistakes. They remain underpriced for too long because of sentiment, etc. And then when they say, oops, I made a mistake, you get ballistic moves. And I think that's what we're seeing. We see it technically happening. And when I say 60 to 70, all I mean is we're going to just blow out those silly old highs, because they really are silly. Because given the monetary degradation since 2011 or 1980, silver would probably be $200 to match the real buying power of silver at those peaks. And ultimately, that's probably where it's going. I'm just talking about this surge. And I think that because of folks are so silly focused on 50 and 50, that a lot of people are going to think that's technically important to take it out, and they're finally going to wake up when silver does blow through that silly price level. And then you're going to have the public say, well, golly, all-time new highs in silver, why wasn't I there? In fact, in real dollar terms, it's still undervalued taking out those highs. But I think that you're going to gush through that, run all the stops, so to speak, suck in new money that hasn't been in at the appropriate places, and won't level off and pause until you get up to about 60 or 70. We've got a few technical reasons for that. But that's not the top. I'm just talking about this surge, meaning between now and year end. We're arguing this particular wake-up phase in silver, where it finally does what copper's already done, take out the 2011 high, what gold has amply done, taking out its prior major peaks.
Silver has a history of sudden, breathtaking rallies. In 1979-80 and again in 2010-11, silver shot up rapidly after years of underperformance. Today, despite massive money supply growth, silver trades below both its 1980 and 2011 peaks, levels gold and copper have already surpassed. This disconnect suggests silver is grossly undervalued. Once sentiment shifts and technical resistance around $50 is broken, silver could surge past $60 or $70 in a matter of months. History shows markets often ignore fundamentals until a tipping point, then rush to correct the mispricing violently.
Silver's going to rush those old highs. It's been a major technical and fundamental mistake for it not to have already done so, along with copper, for example, and gold. And on a monetary basis, in real dollar terms, if you undegrade the price of silver and put it in line with where the degraded dollar really is now versus where it was in 1980 or 2011 peak in silver would probably be $200 an ounce just to match those highs in real spendable dollar terms. In other words, to compensate for the monetary degradation. But we're just talking technically about this particular surge because we think those two highs, we call them idiot highs. Frankly, because they are stupid, because they're so many decades ago that they're next to meaningless in real value terms. But everybody is aware of the two peaks at 50. And so when every investor out there is aware of it, that's the point where they'll finally wake up and get a smack in the face and say, gee, why wasn't I already there? And that's when they'll get interested, and you'll no doubt get some gushing buying on the other side of 50. You're not going up to 50 and stop again, okay? You'll blow it out. And when you do, you're going to get a gush of buying, and it'll probably at least take you another $20 or so.
When adjusted for decades of dollar devaluation, silver's real value at its past peaks would translate closer to $200 per ounce today. While few investors factor this into their outlook, the math is straightforward. Fiat erosion demands higher real prices for hard assets. Current resistance levels near $50 are psychological barriers rather than meaningful value markers. Once broken, momentum could accelerate rapidly. Retail investors long sidelined will likely flood back in when headlines scream new all-time highs. That influx of new money can drive silver far beyond its so-called ceiling, proving $200 isn't a fantasy but a logical target.
And again, there's minor technical reasons for that. It's not a long-term top. We think silver ultimately may go to like $200 an ounce over the following year. There are other factors in play here that will facilitate or stimulate that further move in gold and silver. And that is the breakdown in the stock market, which always then is followed by massive breakdown in the data points. Employment numbers go bad really, really fast. Factory output, all the numbers that the Fed likes to look at and use as their academic excuse, they'll have. And in which case, and plus we have a president who wants to print, okay? So, he wants a Fed chair that will do the same. So we know that's going to happen. In fact, it's going to happen before Powell leaves because he'll have enough evidence, and already he's got enough objections from members of the Fed board to have to pay attention. It was 2, now it's 3 and 4 saying, yeah, we need to cut. Okay, so it's going to happen. And that means that the Fed, again, will put their pedal further on the floor, put their foot onto the pedal, and you'll have monetary excess in all kinds of different ways. You'll see it in the M2, you'll see it in Fed on the rate cuts, and also see in their buying, their balance sheet, because there will be emergencies out there. And we're looking at certain areas in the stock market that most people aren't. Most people look at NVIDIA and Microsoft, and I'd pay real close attention to them right now, especially where they close this week out. We've got some numbers that are being, especially on Microsoft, that are being threatened right now. We get a couple days left in the week, but you break them, all of a sudden, one of the two remaining leaders of the Mag 7 will start to go down sharply, and that's going to surprise people. And probably help take the market down, because in that last break we just had in the S&P a few weeks ago, Microsoft and NVIDIA did not break the same metrics that we saw broken in the S&P and NASDAQ. Now, if they're ready to break down, then all of a sudden,
Silver's trajectory is closely tied to central bank actions. Whenever stock markets falter, whether during the dot-com crash or the 2008 crisis, the Federal Reserve responds with aggressive rate cuts and balance sheet expansion. Today, political pressures all but guarantee further money printing. Rate cuts may cushion markets temporarily, but history shows they don't prevent bear markets. Instead, they accelerate capital flows into safe havens like gold and silver. As equities weaken and liquidity floods the system, silver is poised to outperform, especially given how underpriced it remains compared to gold, copper, and even housing.
Your leadership, even in the Mag 7, is no longer 7. You're now down to 2 or 3. That's it. The other 4 are not leaders. You compare it to prices they were at the last year, and they're so-so. Anyway, once that happens, that's when the central bank goes full throttle again. And especially if we know Trump's going to pick somebody who's going to go full throttle. And therefore, book it. And the problem with that is, if you go back historically and look at the 2000 to 2002 bear, or the 2007 to 9, when the Fed went full throttle, it did not help the stock market. They cut rates all the way down, and the stock market imploded anyway. So it did help something else, gold, okay, during those periods of time. So I think that's why we're watching the stock market, because it's a inverse trigger for gold. Bitcoin is, if you'll overlay, and we did this in a recent report, go back to about 2023, and overlay a monthly price chart of Bitcoin futures on top of a monthly price chart of the NASDAQ 100, you think you have twins. Almost month to month, they move together. Bitcoin is not moving like an alternative to the stock market. It is moving as a speculative bubble in sync with the NASDAQ 100, the leader index in the U.S. stock market in terms of bubble quality. And when we look at the technicals of Bitcoin, it's at 122,000 right now. It's at its highs. It was there like a month ago too. Let me ballpark this. There's some momentum trigger levels that we're monitoring that adjust up every quarter. So this quarter, they're down there a bit in the 90,000s. Next quarter, they're going to be up about 103 to 105,000. So, not all that far below where we are now. You break those numbers, you're going to crash Bitcoin. It is a crash structure on quarterly momentum that is built and ready to use. It is precisely an overlay of the same momentum lethal structure that had been built by the S&P 500 prior to its 1987 crash, where price came off of a summer high, August, September of 87, pulled back in a way that didn't look meaningful on a price chart, but it blew quarterly momentum floor that went back to 3 prior lows, all right around the 3-quarter average.
While silver waits for its breakout, investors are glued to tech stocks and Bitcoin. Yet patterns suggest both are moving in lockstep with the NASDAQ, not against it. If markets crack, Bitcoin, now deeply tied to institutional portfolios, could fall sharply, potentially below $110,000, triggering cascading losses. Such a breakdown would shock investors who believed crypto was a safe haven. Meanwhile, silver, historically a true counterweight to fiat and market stress, could become the ultimate beneficiary. When investors scramble for real, tangible assets, silver's time to shine may finally arrive, explosively and without warning.
Well, Bitcoin has done that precisely for the last couple years. It's had 3 lows that stop precisely on the oscillator at a 0 line, meaning at the 3-quarter moving average. Well, that average this quarter is in the low 90,000s. Next quarter, mid 100, 305 maybe. Also, I'd look at, if I were just looking at a price chart of Bitcoin and operating on the assumption that we are, that it is moving with the NASDAQ. Therefore, if the NASDAQ goes down, you can bet Bitcoin's going to turn with it. You get Bitcoin back below 110,000. Again, pump up a price chart and you'll see that in this advance since 2022, 2023, we get bullish in 2022, by the way, late. It goes in layers. It'll make a peak and it'll have distribution, repeated selling at the same price level for months sometimes. And then it'll break through it, have a next surge, and you'll find a pullback that pulls back to that same old high. And the buyers come in and they buy it on the old highs, which is kosher. It goes up again. Well, the last set of highs we had was in late 2024, early this year, same time the NASDAQ was making a high prior to its April sell-off. Bitcoin also sold off into April, came up and blew out that high. Those highs were all either side of 110,000. So I would argue, just even on price, that if you slip and close a month out, or even a week, much below 110,000, you better get your helmet on. Because this is a bubble that is probably the last upwave you're going to see, and it wouldn't shock me if Bitcoin got cut more than in half and did a lot of that fairly quickly. And that would be a financial and psychological ambush to stock market investors. I say financial because if you go back 5-10 years, Bitcoin was not intertwined with major companies. There was not a lot of capital commitment to it from major corporations, from major funds, etc. Now suddenly you have a lot of deep investors in that area that are, in effect, jeopardize their own company by doing so. But they feel very comfy about it. Well, I suggest they listen to what I just said. You don't want to get back below 110,000. You better start factoring in risk control, because that is a market that could, if it goes down sharply, and I suspect it'd go more sharply than will the stock market, by the way, it will have real-world headline effects. This company here, that company there, that suddenly we're hearing stories we didn't expect to hear. So I would have a keen eye on Bitcoin right now. Again, it's 122. Recent lows been down around 113, 114,000. So it's been sort of in a zone. Don't drop back below 110,000.